Good afternoon, everyone. Today I would like to tell about method that we use to make financial statement analysis. There is five type of analysis method, that is trade analysis, comprehensive analysis, financial ratio analysis, cash flow analysis, and segmental analysis. In the following section, information that financial statement such as the statement of profit and loss and other comprehensive statement as known as the statement of comprehensive income, the statement of financial position as known as the balance sheet, and segmental report and the report of cash flow are used to measure the variable financial statement analysis. Trade analysis is a statistic technique that tries to determine the future move of the given variable. Analysis historic trade. In the other word, it is the method of aim to predict future behavior by examining past one. So research has suggested that the period of 5 years or long as the observation period is necessary to carry out trade analysis effectively. So the formula of the trade analysis is the percentage change in year 1, year 2 and year 1 base year. Changes in year equals to changes in year 2 and year 1 over year 1 variable times by 100. So this is the example of the trade analysis. Comprehensive analysis, as also known as common size analysis, is where the analysis of the entity financial position is carried out by the comparing financial information within the entity and which the industrial average and other entities such as the comparator. There is three type of comparison used to comparative analysis, that are, and there are an entity basis, internal entity basis, and industrial average. Financial ratios are the main component tool of financial statement analysis. They are ratio components aimed to meet investor investment decision making needed. On the part of the company management, the financial ratios are used to mentor, measure, and reward the worker performance. There is three type of financial ratio, that is profitability ratio, equity ratio, and solvency ratio. Profitability measure ratio a measure for profit or operation performance for the entity over a given period. Equity ratio measure to the short term of able of entity to set its due obligation and meet unexpected cash settlement. Solvency ratio measure to able of a entity to stay together going concern over its business life. Profitable ratio, under profitable ratio we have return ordinary shares, return on asset ratio, profit marginal ratio, gross marginal rate, operating expenses to sales ratio, cash return on sales ratio, earning per share, that is EPS. price earning ratio, and payout ratio. Equity ratio. Under equity ratio, we have current ratio, quick ratio, profit marginal ratio, current cash debt leverage, receivable turnover, average collecting period, inventory turnover, average days in inventory. Solvency ratio. Under this ratio, we have debt to total asset ratio, time interest earning, and also cash debt ratio. Cash flow analysis. The statement of cash flow of entity provide information about entity cash inflow and outflow from these it operational activities as well as investment and financing activities. Users of financial statement would be more interested in whether the entities can gain cash from this operation. This is the example of cash flow analysis. The final analysis is segmental analysis. In this analysis, the financial report information is also presented in segment report to provide information to users of financial statement about the revenue, expenses, result, or known as profit or loss, and asset and liability of a segment referred to MFRS 8 operational segment. For future information on segmental reporting, this is the example of segmental information reporting. That's all for this topic. Thank you.